It's Sunday the 20th of May 2018. I haven't done some charts for probably 5 or 6 weeks. I think the last time I did a gold chart was when we had this little breakout above 1320, and it looked like it wanted to go higher and test that resistance zone again in that 1350, 1370 sort of area. It did that. I think my call was for this sort of repeat of that range, wasn't able to manage that, and now it looks like it's sort of done more of like a double or triple top sort of formation there, and failed again. And importantly, last week, obviously it's broken down below 1300, so you probably have to say a bearish continuation is likely here, and heading toward perhaps a repeat of this move here, heading toward this 1260 sort of area, which is also the rising trend since the bottom in 2015, late 2015. So that's probably a probable downside scenario at the moment, and that's, while the US dollar is strong, that's potentially, I think, a likely outcome. The mining stocks I often use as a bit of a leading indicator of the gold market in general, and they're not really selling off hard. I'll show those GDX and GDXJ charts in a minute, but there's not a lot of fear in the mining stocks at the moment. So I don't think a lot of traders aren't thinking this is a huge downside to come in gold, for example. And I think this is mainly US dollar related. So I'll look at the US dollar index chart as well, if I can find it there. Now this one's obviously had a good run in the last probably 3 months now, after bottoming in that February, March sort of time. And it's rallied hard back up to sort of this 93, 94 level. I've drawn this red box in here as just a general resistance area from the 3 years or 2 year topping formation in 2015, 2017, and that's where we are now. So whether we can break out above that, I don't really know. I still think that this is a bear market rally in the US dollar, and it's likely to turn down again just because the fundamentals of the massive government debt of the US and the increasing deficits this year. That's sort of my thesis for a falling US dollar, and I think that's going to be bullish for gold as well. The S&P 500 is looking interesting as well. I think if you look back at my last couple of videos, my thesis for this that we have seen the top, and that was in February, and that I'm using the analog of the dot-com bubble peak for what I potentially think we'll see here. So in the dot-com bubble, we had that peak in March, and then the market tried to rally up again into the US summer in July, August, and failed to make a new high. And that's kind of what I talked about probably 2 or 3 months ago here, when we started this sort of rally back up, and in February I was predicting that we might see a continuation of this sort of bearish action, this volatility until the US summer, which we're starting to get into now. And I think my call was for this sort of 2750 area, or 2780 maybe, I can't remember, but it was in that sort of range, and we're still below there. Potentially, you could argue there's been a little bit of a double bottom here around this 2600, and we could see a repeat of this move above the breakout there, back towards sort of 2800 on the S&P. And that's, potentially, but I still at the moment believe that we have seen the high in February. One thing, a couple of things. This is a tweet I saw a couple of weeks ago, and I think it really summarizes things quite well. All the factors that are playing out in the market have historically been bearish for the stock market, and sometimes it takes a while for those things to come true. But we've got rising oil prices, rising interest rates, a slowing economy. You could argue that's not necessarily true, and a Fed rate hiking cycle, and the new one is the Fed balance sheet unwind. Obviously that's from quantitative easing, and that's, people have been talking a lot this week about the bond yields again if you remember in February, the thing that really sort of tipped the market over the edge was that the bond yield peaking at around or just under 3%, I think, on the 10-year, and that the market started to realize that that's not bullish for stocks, and that's again this week now we've made the bond yields, the 10 years gone above 3% comfortably, and looks like, and now it's at a 7-year high there, and it looks like it wants to go higher, and probably considerably higher on the basis of this chart. So I can't see, this rally in the S&P has been driven by low interest rates, and low cost of money. There's a lot of debt in the system. I don't see this and particularly at a corporate debt as well, and that's not going to be good for US stocks in the medium to longer term. So while this can continue to sort of get choppy action here, I think more and more people are going to start looking at those yields, and it ain't going to be good for stocks. I think I read this week that the 2-year Treasury yield is now higher than the S&P 500 yield. So you can get more money risk-free supposedly in those 2-year Treasury notes than you could in putting your money in the S&P with considerably more risk. So that's my thesis for the US stock market, and I haven't changed my view, and the price action is not really suggesting that there's any major rally here, and I think maybe it continues like this for another month or two before starting to trend lower, and those bond yields, if they keep going a lot higher, that will really start to play as a factor in the market more than it has probably. The exchange rate, Australian dollar versus US dollar. So Australian dollar is really struggling here. I think in the video I had a few weeks ago, I was talking about it. It was probably trading around 76, 77 at that time, and I was looking for it to come back and test this lower trend line. Broken down through there, and now sort of not showing a lot of strength here. I guess all currencies, including gold, are struggling versus US dollar at the moment. But I think even if the US dollar starts to reverse its strength, I don't see the Australian dollar rising considerably. And that's I've said that for a long time in these videos, and that's why I've got a bias toward Australian dollar focused gold miners. And that's Australian dollar gold. I talked about the last video, I reckon, about this 1720 level was a key level. That's was the 18 months sort of resistance, and had broken out strongly above that, and that coincided obviously with that fall in the exchange rate, and now it's come back and testing that 1720. So we're at a sort of a critical juncture there, but there's nothing to suggest the Australian dollar's going to come back strongly. And I think even if gold falls, I think the Australian dollar is probably going to fall more as a weaker currency alternative. So that's likely to be strong for Australian dollar gold miners. I mean, most of this rally in the Australian dollar gold price has actually occurred while US dollar gold prices were falling. So, even if the gold price is falling in US dollars, that doesn't mean that it'll fall in Australian dollars. Obviously, it has in the last week or two, but I think the trend is still higher, and I don't see any reason to change that. The gold mining stocks, as I said, are haven't been performing too badly. Often when we had these strong US dollar rallies in 2015, 2016, you'd get those massive drop-offs in the gold stocks. But you can see here, even on the GDX, it's only down sort of 4 or 5% this week, or even less than that. And it's had that one drop, and then it's kind of consolidated here. Very choppy sort of chart, but I don't see huge downside at the moment. Obviously, we've had that big resistance there on that 21 level on the GDX. Maybe it comes down there another 4 or 5%. But in the scheme of gold mining stocks, 4 or 5% is nothing really. That's just normal volatility. So they're not showing massive weakness, and you could argue that I think they're showing relative strength compared to how they've performed in the past when you've seen those sharp moves down in the US dollar gold price. See there, GDX is pretty similar. consolidated after that move that probably dropped 3 or 4% there, and then consolidated the last few days of the week. So it's general rising uptrend there, but still choppy action and not a lot happening. But I think in general they're showing quite good strength, and that's why I'm still sort of cautiously optimistic that gold is going to perform reasonably well here, even if it has a little bit further downside. The ASX 200 is an interesting chart. It's really rallied strongly in the last 6 weeks and gone back up toward that that high that it had in January. And to me, this is I know the bank stocks have really been struggling, and obviously I've talked about in the past that the ASX will struggle to rally when the bank stocks are struggling, and that's it's gone against that in the last 6 weeks. The banks have been going way down considerably. Very poor moves there, down sort of 10-15% with the Royal Commission into banking stocks in Australia, or banking companies and general financial services. So with those moves down, it's unusual for the ASX 200 to be rallying. And of course, Telstra also has had a lot of problems on the Australian market in the last few weeks. It had another drop lower to I think 7-year low this week, and that's probably doesn't have the weighting it used to have in the index. But so it's strange for the index to be rallying, but I think there's a couple of stocks that are really responsible for a lot of that rally. BHP is one of them. That's up strongly in the last 6 weeks. Up about 20%, bit more, 25% almost, from 28 to 34. So that's been a pretty strong move. So this is probably the weaker Australian dollar is helping some of these companies. Rio Tinto, if the chart comes up, pretty similar to the BHP chart. That's rallied from 72 to 85 again, so that's a little bit less than 20%. And I think CSL, another one that's performed well, and all of those companies are in I think probably in the ASX 10 at the moment. CSL up again almost 20% since the start of April. So those three have really offset some of the banking stocks, but this Commonwealth Bank chart is horrendous, and that Royal Commission has got a long time to go yet. You can see here it's really formed sort of a 3 falling peaks formation. I think I've talked about this before in these videos, but that's quite a bearish formation and quite a reliably bearish formation as well. And that's this $70 level on CBA is quite crucial. And if it breaks down through there, I think there's considerably more downside. And with the rate that these scandals are getting released by the Banking Royal Commission, I think it's more than likely that there's going to be another one that affects these banking stocks further. I know AMP's had been sort of dealt the biggest blows recently, but I think the banking stocks have got a lot further to fall here. And you're seeing the impact on lending standards as well. They're having to tighten lending standards, and that means they can't issue as many home loan products, and that's really what's driven these stocks for a long time. They're massively correlated with housing prices now. So it's I think 60 or 70% of their loan books are in housing. So that's going to be way on their share prices. So I don't see how that can. I'll bring up a couple of the other ones actually while they're all pretty similar. ANZ, again, very weak sort of chart. Probably not quite as weak as the CBA chart, but I think ANZ probably hasn't come out too badly out of the Royal Commission compared to some of the other banks. But CBA, NAB as well. Yeah, that's another sort of got that sort of look of a 3 falling peaks formation there again, and that suggests further downside. But that's sort of an aside. I follow these banking stocks a lot because obviously they're a driver of the ASX 200. But all in all, sort of I guess interest rates are a focus at the moment for gold and for the US dollar. So those bond yields are very important, and how they come and affect the gold price, US dollar, and the S&P 500. But gold in general looks looks like it's got further downside here. That consolidation sort of after that down move suggests likely further downside, another $30 or $40 perhaps. But I don't own gold. I own gold stocks, and the stocks look relatively strong. So that's what I'm most concerned about, and why I'm not haven't been selling majorly. I have been selling probably 3 or 4 weeks ago after there were some strong rallies in particular in some of the junior gold names that had struggled probably the last 6 months of last year, like Silver Lake and Ramelius, and they've had tremendous returns in the last couple of months. So I've been taking some off the table there, but in general, I'm holding my core positions and not overly concerned yet about this move. But you got to be cautious as always in the gold market.